Welcome to The Income Generation, the show where we share valuable financial information for that critical period in life when you're either in or approaching retirement. I'm David Scranton, your host. If you have money in the stock market and have a broker who is someone whom I call a typical Wall Street cheerleader, you've probably heard him doing a lot of cheering over the summer as the markets hovered at record highs. And chances are, you heard him or her go right on cheering a few weeks ago after the Dow, the Standard & Poor's 500, and the NASDAQ all went into a tailspin. So what exactly is a Wall Street cheerleader? Well, here's one example. Now, if you've ever been to a football game, you know that the thing about cheerleaders is this: they never stop cheering. Their team could be down by 50 points late in the fourth quarter, and they'd still be singing, clapping, and rah-rahing all the way to the bitter end. It's their job to be optimistic and to try to keep you optimistic and to ignore little details like whether or not your team is winning or getting absolutely clobbered. Wall Street cheerleaders are a similar breed, whether it's a broker, an advisor, or a television analyst like the one you just saw. If they are married to a stock market-based business model, then it's in their best interest to keep you consistently optimistic about the market and where it might be heading. And just like all those football cheerleaders, one of the ways he might accomplish this is by ignoring or trying to distract you from important details. I mention all this because on today's show, we're going to be looking at some of those very details, the ones the Wall Street cheerleaders are trying to ignore. We'll also talk about why a lot of these details are getting increasingly hard to ignore, even for the most determined cheerleaders. As you probably recall, if you're a regular viewer, we did a show just last month on the current state of the financial markets, and I pointed out then that attention to detail is one of the core values necessary to successful saving and investing. That is especially true in today's market. And of course, today's market has been accurately described as a, quote, mess of contradictions. If you're within 10 years of retirement, it's so incredibly important to understand these contradictions and how they could potentially impact your portfolio. And the only way to do that is to examine the details behind the numbers and all the hype that you may be hearing from all these so-called Wall Street cheerleaders. So I wanted to do a follow-up show on the markets because since last month, the mess of contradictions has gotten even messier. I'll explain how in today's market breakdown portion of the show, and I'll share some thoughts on how you might better protect your nest egg from an encroaching economic storm. Now, if you've been tuning out the cheerleaders and paying attention to the details yourself in recent weeks, you probably know that I'm not the only economics expert forecasting this storm. In the weeks since our last market show, new reports and articles have come out almost daily calling attention to the dramatic rift that now exists between our financial markets and the true state of the global economy. The majority of these reports draw basically the same conclusions. The forces behind the record high markets we've seen recently are mostly artificial and therefore unsustainable, and that eventually something has to give. If you want a visual image, think of an overinflated balloon or perhaps a tree branch bent to the point of snapping, or maybe the one that's most accurate, a drug addict about to crash, which I'll talk about later because you may already be seeing signs of that impending crash. Now, if your own broker or advisor has not been talking about any of this, but isn't necessarily a Wall Street cheerleader, it may be simply that he or she has focused only on what I call the outside game of saving and investing, the external factors. Now, that's a pretty common approach, but it's also a risky approach because it neglects the core values that also are needed to protect your money, including the one I've been talking about so far today, attention to detail. That's all part of what I call the inside game of saving and investing, which, yes, I've discussed on recent shows and in my new book called Return on Principle, 7 core values to help protect your money in good times and bad. One thing I believe that most successful investors have in common is that they've mastered this inside game, which should hopefully tell you something about its importance. In fact, you've heard some of them right here on this show share their thoughts about today's market mess and stress the importance of understanding what's happening today and the potential risks involved. especially for anyone within 10 years of retirement. Now, with all that in mind, let's take a fresh look at all the new and important details on today's market breakdown. And later in the show, we'll hear more timely insights from our special guest. So stay tuned.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Now, as you may recall, the stock market actually got off to its worst start in history in January and February of this year. It rebounded in March, but continued showing strong resistance against further growth. Then, all of a sudden, in June, it briefly plunged in response to Britain's surprise Brexit vote to pull out of the EU, which was understandable and was expected. But what happened next was a lot less logical. On the week of July 11th, all 3 major market indices hit new record highs and then continued breaking those records for several days in a row. From there, the markets hovered at those record peaks up until just a few weeks ago. On September 9th, the stock market experienced its most dramatic one-day plunge since this Brexit vote, with the Dow dropping 400 points and all 10 sectors in the Standard & Poor's 500 index ending up in the red. The markets then rebounded the following Monday, but sank again on Tuesday when oil prices dropped. Since then, we've seen an increase in intraday volatility, which many experts believe is here to stay now that the fall has finally arrived. October, let's face it, is typically a dicey month for financial markets anyway, and historically speaking, many major market indices have dropped and actually crashed during the month of October. In truth, though, the return of volatility and investor nervousness makes a lot more sense now than what we experienced all summer, which was a market riding these record highs despite the lack of any real improvement in our own economy or the troubling global economic picture for that matter. In fact, a recent Business Insider article listed several factors indicating the true health of the global economy right now, and none of them pair logically with record market highs. Factors such as the IMF, International Monetary Fund, has regularly downgraded its global growth forecasts. Britain's decision to leave the EU is still battering its economy and having ripple effects all across Europe. The potential impacts of China rebalancing its own economy is still a huge unknown. And remember, it was China that caused another major one-day flash crash just a year ago. Let's face it, inflation barely exists in most developed countries, including our own, while developing nations are trying to restrain runaway inflation. In the middle of all of this, the United States remains a relative bright spot. And that has actually been one of the factors fueling the artificially inflated stock market. As I put it before, we are still the cleanest dirty shirt in the world's economic hamper. But there again, if you apply the inside game and take a closer look at some of the latest details behind our own economy, the reality isn't nearly as bright as the illusion. Consider the GDP growth rate for the year so far, one of the most important indicators of economic health. Last year, the GDP was up 2.5% for the year, while the best projection for this year has it up just 1.5%, and many projections hovering right around 1%. In other words, we've gone backward, which obviously is not good. As for corporate earnings, another crucial economic indicator, earnings growth for the Standard & Poor's 500 during the second quarter of this year was a negative 3.2%. This marks the 5th consecutive quarter for declining earnings growth. Overall, corporate earnings are down nearly 5% over the last 4 quarters, which again is obviously nothing to cheer about. How about jobs? Well, you may have heard some Wall Street cheerleaders recently trying to put a rosy spin on the latest federal report about jobs growth. But you have to keep in mind that statistics alone can be skewed and can be spun in different ways. I believe it's important to look beyond the numbers at the relevant details, one of which is that the labor participation rate in this country now stands at 63%, which is the lowest it's been since 1978. Many workers were displaced by the Great Recession and eventually just gave up trying to find a decent paying job. And much of the minimal growth we've seen in the labor force over the last few years has been in low-wage employment. Again, rah-rah. So what about interest rates? Well, Fed Chairman Janet Yellen keeps talking about raising short-term interest rates, again, sometimes this fall or winter. But with inflation still at less than 1%, most analysts agree that she may just not be able to do it. Another reason that even a small rate increase could do more harm than good is something I've talked about many times on the show, and this thing we call the flat yield curve. The difference between long-term and short-term rates. See, long-term rates, interest rates that is, are still lower than ever, with interest rates on the 10-year Treasury significantly below 2%. If short-term rates go up, this could create a flat yield curve, which is a disincentive for banks to lend money. Again, something very, very bad for the economy. Add to this the fact that our own dollar is continuing to strengthen compared to other currencies, which not only works against the inflation we're trying to create, but also hurts the ability of our multinational companies to export products. Oh, and let's not forget about our sky-high national debt, which has actually doubled in the last 6 years, or the potential economic impact of the upcoming presidential election. What all of this seems to have made clear to an increasing number of analysts and economists is something that I've been saying since 2008, that there's a clear and potentially dangerous disconnect between market performance and economic fundamentals. The cause? Well, once again, an increasing number of experts are blaming the same culprit that I identified 8 years ago. Central banks like our own Federal Reserve and their reckless policies. Their overuse of this artificial economic stimulus, including 6 years of quantitative easing right here in the United States, has created a global market that's dangerously out of whack with reality. Many new reports and articles about the situation in recent weeks have included quotes from economists calling the markets everything from broken to senseless to dysfunctional. Through bond buying, money printing, and manipulating interest rates and other artificial measures, central banks have forced investors up the risk curve by convincing them that the stock market is the only game in town. They've created the illusion of economic recovery and growth and tried to force that reality. But the more likely reality is that the markets are still feasting on some $200 billion a month in stimulus being pumped by central banks around the world. And the growing concern is that as these stimulus options become increasingly limited, which they are quickly becoming more limited, the markets will be forced to face reality. I actually cautioned about the potential long-term dangers of all this back as far as 2008, when the Fed just began instituting its first round of quantitative easing. In fact, I called it caffeine for the economy and pointed out that once you introduce artificial stimulants into any system, whether it's your own body or the economy, you create the potential for dependence. The more you use them, the more dependent the system becomes. Despite that danger, the Fed kept going, and central banks around the world followed our dangerous example. Now, here we are with an entire global market dependent on economic steroids, as I love to call them, and increasingly worried about the painful withdrawal once the drugs finally run out. All of this gets to why I always stress the importance of the inside game and the core values in saving and investing. It also illustrates why the first core value I advocate in my book and in my own business model is financial overprotection. Keep in mind that on top of the mess of contradictions we're in right now, The lessons of stock market history suggest we still have several years to go in our current long-term secular bear market cycle. They suggest further that we're overdue for a third major market drop, similar to those we saw from 2000 to 2003, and again from 2007 to 2009, meaning a drop of somewhere between 30 and 70%. If this current secular bear market were really to be over after just 13 years, from 2000 to 2013, it would have been the shortest such cycle in history, and the first to end with fewer than 3 drops, which to me seems extremely unlikely. In light of all that, I hope it's clear now why I wanted to revisit this topic today. In fact, another core value I stress in my book and in my practice is diligence. And that means focusing on the important details and how they change from day to day, and doing all the hard work it takes to be a successful investor. And with the markets under the influence of so much artificial manipulation today, that kind of diligence has never been more important. To put it simply, and despite what the Wall Street cheerleaders may now say, now is not the time to leave your money on autopilot. Stay with us. We'll be right back. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Our special guest today is a man who needs virtually no introduction with most of our Income Generation viewers. Larry Kudlow is a senior contributor at CNBC and previously hosted CNBC's The Kudlow Report. He currently hosts a national radio show and is a syndicated columnist. During the first Reagan administration, Larry was the Associate Director for Economics and Planning in the Office of Management and Budget. This put him right in the thick of the decision-making process that led to that economic transformation during that time. His latest book will be competing with mine for readers as they're both released the same week at the beginning of September. It's entitled JFK and the Reagan Revolution, A Secret History of American Prosperity. Larry, welcome to the Income Generation Show.
Thank you for having me. Appreciate it.
It's our pleasure. You know, there's been a lot of talk lately about taxing the wealthy at a much higher rate, especially from Democrats. And during the 1960s, the economy was strong, following some sweeping changes that JFK made to tax rates. Do you think JFK today would be in agreement with modern-day Democrats about whether to raise taxes or perhaps in the camp of slashing taxes?
Well, you know, it's an odd story. It's the story we've written about. It's a story that's never been told. John F. Kennedy, a Democrat, was the first supply-sider. In 1961-62, he outlined tax cuts. Now, mind you, marginal rate cuts, okay? Marginal tax rate cuts. He cut them for the top, for the middle, for the bottom, for corporations, for capital gains. Why? Because he believed more money in your pocket, more incentives and rewards to work and invest would boost the economy. And guess what? It did. In fact, I guess between 1962 and 1969, the American economy grew at 5% per year, adjusted for inflation. It was a fabulous success. And today, the Democrats have completely rejected the JFK tax cut model. They have written his legacy out of their history, and they've all gone to the left, including Hillary Clinton, the candidate, and all she wants to do is tax. She wants to tax rich people. She wants to tax corporations. She wants to tax capital gains. She wants to tax financial transactions. I guess you could say if it moves, she wants to tax it. Let me tell you, it won't work. Kennedy was right. Clinton is wrong. It won't work. You're never going to tax your way into prosperity. And all we did, Brian Dimitrovich and I, we just wrote this history, which has been completely forgotten. I reckon if JFK were alive today, he would be a supply-side Republican.
Yeah, and it happened when JFK helped get us out of a tough economic situation, and it happened again with Ronald Reagan. Reagan basically did the same thing and got a very similar result that President Clinton, Bill Clinton, actually rode his coattails in many ways as the economy prospered throughout the 90s. So why is it, do you think, that today Democrats don't see that?
It's an odd story. I mean, even Bill, look, Reagan basically emulated JFK's program. We have quotes in our book. Jack Kemp, who was my mentor and got me into politics, the late Jack Kemp. You know, Kemp said at one point in, I don't know, 77 or 78, and we have the quotes from his staff, you know what, guys, let's just use the Kennedy tax cuts. And that's what they did, marginal tax rate cuts. He sold it to Reagan. Reagan put it to work. Now, Bill Clinton's first couple years, he went back to the old left-wing mantra and said, we got to raise taxes on the rich, quote unquote. All right, he did that, and then he tried to nationalize health care, and he got killed in the elections, killed. Second Clinton term, he lowered the capital gains tax. He reformed welfare. It was like Reagan's third term. Now, to your question, the Democratic Party has just moved so far to the left. That's the only explanation I can give. The mantra is let's reduce income inequality. Let's redistribute income. Let's punish success. Let's spend as much as government can possibly spend. And the sad tale there, first of all, it doesn't work. It doesn't work. Republicans have tried it in the 70s. It never works. The second point I want to make, which is maybe more important, there is no reason why the Democratic Party couldn't go back to its JFK roots and become a tax-cutting, pro-growth party. There's no reason. Right now, for example, Mrs. Clinton doesn't even have a plan for corporate tax reform, which I think is the biggest issue, holding back the economy.
Of course.
Well, even Obama has a tax reform plan for businesses. Trump has a very strong tax reform plan, 15% for all business. There's no reason why Democrats couldn't be tax cutters, none whatsoever.
So Larry,
but they are so far to the left, they just can't get there.
So Larry, what else did you talked about? Really making it friendly for business is what I read between the lines. What else did Kennedy and Reagan do to make a more business-friendly environment for corporate America that ultimately would help the economy flourish?
Well, I'll tell you, one other value they shared, they both believed in a strong, steady, reliable dollar. And this is an underrated issue because we haven't had a strong, I call it king dollar, okay? We haven't had king dollar since the 1990s. Robert Rubin, who was Bill Clinton's Treasury Secretary, was the last strong dollar guy. Now, Kennedy wanted the dollar to be as good as gold. He used to call his Treasury Secretary, Douglas Doolan, a Republican, to make sure. Ronald Reagan wanted the dollar to be as good as gold or steady. Dollar collapsed in the 1970s. The dollar collapsed in the early 2000s under George W. Bush. You can't have investment from overseas. You can't keep American money here if the currency's collapsing. It doesn't make any sense. So Kennedy and Reagan agreed. Lower tax rates for growth, a sound dollar for investment, and stability and international standing. It's just so fascinating to me. Fascinating.
What's interesting.
By the way, one last point.
Sure. One
last point. It's not an economic point. Kennedy was a very strong anti-communist. He was so anti-Soviet communism, and of course, so was Ronald Reagan. So you got these two guys, a generation apart, both saying the same thing, both having great success as presidents. And it is a pity, because right now, in my opinion at least, this country, America, the greatest country on earth, needs these policies. We need to grow the economy with lower taxes and regulations and a strong, reliable dollar. And we have to be tough on, today it's not communism, it's ISIS. We have to be tough on ISIS.
And if you want redistribution of wealth, then don't try to change our country and what we're built on. Go ahead and move to another country where you can have your redistribution of wealth. Stay with us. We'll be right back with more from Larry Kudlow and his new book. We'll be right back. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Welcome back. I'm here today to ask the tough questions of someone who's never afraid to ask the tough questions, Larry Kudlow. His new book's coming out in just a couple of weeks, entitled JFK and the Reagan Revolution, A Secret History of American Prosperity. So Larry, we talk about tax rates and tax rates going down and how during the JFK administration and the Reagan administration that helped stimulate the economy from a supply side perspective. But some people would argue that today it's different. With the national debt being where it is today, we can't reduce tax rates. Do you think that this plan could still work even with the national deficit at its current levels?
Absolutely. Look, the key point here is economic growth. Growth solves so many problems, okay? Growth solves lower wages, growth solves lower jobs, growth helps to solve poverty, growth solves investment. Now, the reason I say that is we're running a debt to GDP ratio, which is, I don't think it's off the charts. It's about 75%. I'm not sure whether that's so bad or not. In the next 25, 30 years, it could get worse. Let me just tell you this. Debt to GDP will fall from 75% back to 50% if you start growing the economy at 5% a year, which is where we should be growing it after the deep recession. People always criticize. Liberals love to criticize tax cuts because of deficits, okay? But they never criticize government spending, which gives you big deficits also. The difference is, when you lower marginal tax rates, you're investing in the economy, you're investing in individuals, you're investing in middle-income wage earners. So you get economic growth. Economic growth solves your debt problem. Let me give you a number. I don't want to bore you, but let me give you one number. Congressional Budget Office. Every 1% increase in real GDP above the baseline, every 1% lowers the deficit over 10 years by $3 trillion. So we're growing at 1 to 2% now. If we grew the economy at 4 to 5%, you would be talking about $6 or $7 trillion of lower deficits and debt.
That's a big difference.
And
that's a big difference.
We should limit spending. Don't get me wrong. We should limit spending. We should reform entitlements before they go bankrupt. But I'm just telling you, economic growth solves a lot of problems, including debt and deficit.
So what do we do with interest rates? If you were Janet Yellen right now, what would you do with interest rates? Do you think she can raise rates at all at this stage? I know there's a lot of talk of that.
There's almost nothing about the Federal Reserve policy that I like right now. That's a different interview, and it's a long segment. I don't have much good to say. What I would say is this. Right now, the inflation rate is almost zero, less than 1%. So I wouldn't raise rates. They should have raised rates in 2010 and 2011 and probably 2014, but they didn't. So you've got all these market distortions, and there's a million things the Fed has done wrong, including, by the way, its ignorance about the dollar. There's no king dollar anymore. Having said that, what this country needs is a huge cut in the business tax. That is the biggest obstacle to growth, honestly. And then, if you cut the business tax rate, let the Fed follow economic growth and higher interest rates. Let the market lead the Fed on interest rates. Thank you. That's exactly right.
You're preaching to the choir. I've said similar things on the show. It's incredible. So who has the best plan right now? Does Trump have the best plan? Does Hillary Clinton have the best plan? The Libertarians to help accomplish this goal?
Well, look I don't know what the Libertarian platform is. I think Governor Gary Johnson, whom I've met, I think he wants a national sales tax, which I don't agree with. I don't like that. I'd rather have a pure flat tax like Steve Forbes. I was for Steve Forbes. Maybe 20% across the board for everybody, and abolish the corporate income tax. But I think, look, of the two major candidates, and I'm not going to get into a political mode here, from an economic standpoint, Trump is the guy who says he's going to lower taxes and regulations. And I think that's pro-growth and will be a huge job and wage creator. Mrs. Clinton, on the other hand, wants to raise taxes and raise regulations. I think that's a loser. To me, Trump is the growth guy. Clinton is the recession person. That's the way I see this race right now.
Okay. So in the last minute we have here together, I know time flies when you're having fun. What do you hope that readers will take away from JFK and the Reagan Revolution?
I'm sorry, what do I think which?
What are you hoping is the greatest takeaway from those who read JFK and the Reagan Revolution?
Well, look, people can see, first of all, that you don't have to be partisan and political. In other words, what's good for the country is the most important thing. And what's good for this country and any country is economic growth. That's the key. Growth, growth, growth. Democrats have done it under Kennedy. By the way, in the 19th century, the Democrats were the low taxers, the low tariff people. Republicans have done it under Reagan and since. Sometimes Republicans have been the high taxers. What I'm saying to you is we need some unity. We need some bipartisanship in this country to get the economy moving again and to make America strong at home and overseas. It doesn't have to be Republican or Democrat. What we need to do is to help America, whatever it takes. And I am hoping, maybe hope against hope, that we can lower the partisanship here and sit down and figure out what has worked in the past and then try to repeat it in the future.
What you're basically saying, if I can just interpret, is you're suggesting that our leaders actually begin to use common sense when determining economic policy. And unfortunately, I need to leave it there for now. It's been an incredible pleasure having you here. And so after we get off the air, I think we'll have to talk a little bit about how maybe we can combine our efforts with my return on principle and your JFK and the Reagan Revolution coming out in the next couple of weeks. But Larry, thank you so much.
I'll have you on the radio show. I'll have you on the radio show. That's a promise.
Sounds good to me. I will take you up on that offer. Thank you, sir. All right. It's been great. And for our viewers, stay with us. We'll be right back in a couple minutes to talk more about the important core principles for investors and for financial advisors. Stay with us. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Welcome back to The Income Generation. Today we're talking about why the market's current highs might be unjustified. Now, David, I was just listening to your interview with Tony Laporta, and he's actually quite bullish on the market, but you don't necessarily back his rosy outlook. Why is that?
Well, I think he's making the traditional argument, which says that when interest rates are low, people flood into the market.
Right.
He's making his traditional argument that it's really the only game in town, and that's true historically speaking. However, that's what's fueled the market for 7 years now, and as Tony Laporta said, as our regular Income Generation viewers have heard him say just a few moments ago, that this has been a record increase in the market, what we've seen, a record bull market over the last 7 years and 5 months or so. And whenever something goes up to record highs, to me that's a reason to sell, not to buy. So ironically, I would take his exact argument and I turn it around. But that's why we have other people with other views in the show, because it makes it fun. People get bored just listening to me all the time.
You know, we've talked in the past about irrational exuberance. So is it irrational? Because it seems like the market keeps going up and keeps going up. So it seems like it fuels that exuberance. So I guess what goes up must come down. But at what point is it logical?
Well, it's a self-fulfilling prophecy. And what we have to look at is the fact that the market has been going up. Yes, it's broken through a new peak, and we know that when it breaks through a new peak, it can run a bit further. So the momentum's with it right now. But the reality of it is, think about our viewers, right? Our average viewers are, generally speaking, 50 and over.
Right.
And as a result, they're in a situation where, to me, they only want to invest in things that make fundamental sense. In other words, just because some crazy momentum has driven up the markets, for those who are retired or you who are close to retirement within 10 years, for example, you know enough that it doesn't make sense to gamble on that. Just because the craps table is on a heck of a run doesn't mean you want to put your life savings on that craps table and roll the dice. That's probably the best analogy.
It is. You know, we're talking today about the global economy, and I know so many markets are down. Greece is terrible. England's terrible. Is America what's up right now? Because, of course, if some are down, someone's got to be up. Who's up right now in the global economy?
Well, you just came back from a 3-week trip abroad, right?
Yes.
So think about it. You know, didn't your dollar go a lot further when you were traveling than normal?
Yes, it was unbelievable.
And that's because that cleanest dirty shirt in the hamper analogy that we talked about a moment ago.
I love that one.
And exactly, because, and it's not because we got any cleaner, it's because a lot of the other countries have gotten dirtier. And what happened just really over the last month or so with this whole Brexit issue is the fact that it started to call into question the possibility that the whole Eurozone might self-destruct. Now, I'm not making any crazy prediction. That's only one country out of more than 20. But if another country follows suit, we can have an unraveling of the euro. And now you've got most of the Western world, all those countries except for the United States, that start to look weaker, which means, relatively speaking, our markets look better. The dollar looks better. So when you see this going up, I believe it's a testimonial to the dollar being strong, not so much to our stock market fundamentally being worth more.
Well, anyone that's been following all the political stuff going on right now and who hasn't knows our economy is not great. So if we're the cleanest dirty shirt, how dirty are we, and what does this mean? If all the money's pulling into the dollar and we know our economy is not as strong as we'd like to pretend it is, what does this mean for the global economy?
Well, I think people have to understand first that we talk about corporate earnings. Corporate earnings having dropped for 5 consecutive quarters. Now, this is a bit of a shell game. As you know, the analysts like to come out, right? The analysts come out and say, well, 60% of all Standard & Poor's 500 companies have beaten their earnings estimates. But the reality of it is that if you lower the bar every quarter in terms of your estimates, it's easier to beat the estimates.
Sure.
That's really not a true measure because that gets manipulated.
Okay.
In fact, a lot of corporations actually give what's called guidance to analysts, which is a more bearish guidance, which causes the analysts to give lower projections. So the end result is it looks like we're beating these estimates. The real guide is how have we done this quarter to the same quarter last year. And for a lot of the S&P 500 companies, it's been poor, it's been down. So that's a sign that corporate profits are going down, not up.
Now, how do buybacks play into this as well? Because it does make the corporations look more attractive, but is that really what's going on?
Well, that's part 2 to our incredible shell game that corporations are playing here.
Oh boy.
It's the accountants playing the games to try to manufacture, to try to engineer profits on paper. And the whole concept, you know, the reason why it works on paper and gets people a little bit more exuberant, to use your term, I think you borrowed that term from somebody back in the 90s.
Yeah, you.
Perhaps me. And then,
just you.
And then before the 90s, back to the 90s, so Alan Greenspan, right? But the reality of it is that they engineer these profits because by buying back their own shares, they create an artificial demand for the stock. And stock prices are influenced by supply of stock versus the demand. Supply stays the same, demand goes up, and voila, we have an increasing stock price. What it also does is increase the earnings per share. A lot of analysts look at earnings per share, as do investors. So if you have the same corporate earnings, but you have fewer shares outstanding, then it goes to increase your earnings per share. So again, just another part of that whole shell game that makes me really concerned that your average investor, our income generation viewer, it could potentially get really hurt next time the market takes a significant drop.
Oh boy, it's all very scary. Well, we're going to take a break right now, but when we come back, we're going to talk about what you can do to protect yourself in this unstable global economy, and also alternatives to the traditional stock market.
The closing numbers on the markets today. At one point, the market fell as if down a well, over 700 points.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Welcome back to The Income Generation. We are talking about the unstable global economy and why the current highs of the stock market might not be as good a sign as it appears to be. Now, David, when you were talking with Tony Laporta, he seems concerned about inflation. What does this mean for our income generation, and what should we be doing with our money?
Well, that's a great question, because what he was implying, if you kind of read between the lines, he said, I'm going to stop short of saying we have a bond bubble. I don't like that term.
Okay.
But his concern is that inflation pushes up interest rates. And of course, when interest rates go up, bond prices come down.
Right.
So he's implying that it might not be a great time to be investing in bonds right now.
Okay.
But part of that's because he got Skyped in from a remote location, and he didn't watch the first part of our show that all y'all got to watch, where we talked about the fact that we're turning into basically Japan. We're turning into a country that is, frankly, has more deflationary risks than inflationary risks. And in large part, that's because of spending patterns of the baby boomers. So to me, the same reason that I'm not concerned about inflation is the same reason that you, as a member of the income generation, need to start to make a paradigm shift yourself in how you invest. From instead of crossing your fingers and toes hoping for growth or capital appreciation, to instead investing for income. Because at the end of the day, when you're retired, you can't spend growth, you can only spend income. Isn't that right?
But wait, now this is a good excuse for me to go shopping? Yes? Stimulate the global economy?
Well, I think you have a few years to go before you retire. So I'm talking more to our viewers, not the people that are significantly younger like you.
Okay,
course, yeah.
I'm just trying to do my part here. But, you know, let's get back to real estate, because that's traditionally a very good place to put your money. And I know Tony was talking about a relative that put 25% down. I don't know about you, but that doesn't seem realistic to a lot of our viewers. It certainly isn't to me. So is real estate still a good investment even if you don't have 25% to put down?
Well, thank you for mentioning that. 'Cause you're actually rounding out my argument about potential deflation.
Okay.
The reason why it's so difficult for people today, it's difficult for people today to put a lot of money down, but that's really happened over the last 20 years where we've approved these low down payment mortgages.
Right.
So with long-term and short-term interest rates being close, this thing called the flat yield curve, what's happening is that banks are tightening up. So yes, if you put 25% down, you get a mortgage. If you have 5% down, it's going to be really difficult.
Right.
But the reason I'm so glad you brought it up is simple. Think about yourself. Think about whether you're at a point in your life as an income generation member where you're aspiring to buy your dream home, or whether you've already bought your dream home. Think about whether you're having more children or whether maybe you're about to become an empty nester. Because for most of our viewers, you know, you've already bought that dream home. You're thinking about becoming an empty nester if it didn't happen already, which means that your next move in real estate might be to downsize, not upsize. And that goes right to my deflation argument.
Okay.
And the reason is because in order to create inflation, you have to have more money chasing a limited supply of goods. In this case, if goods are real estate or goods are whatever you might shop for,
Right.
you have to have more money that's going in and spending, and it drives up the price.
Sure.
But what's happening now is our viewers have gotten too smart, and they're spending less, they're saving more, getting ready for retirement, or making sure they can sustain their lifestyle in retirement.
Right.
And as a result, that's creating that deflationary pressure. And the same is true with real estate.
Okay.
Because think about it, if equity on a net basis is coming out of real estate instead of going in, that means that if anything, real estate prices can come down. And that's why when Tony said that he sees all the skyscrapers out there and the cranes, I said, well, to me, that's not a good sign. It's great that people are employed, yeah, the construction workers,
Sure.
but it's not a good sign because last time that happened, we had the real estate crash.
Okay, so where should we put our money? What would you recommend to our generation watchers?
I'd make a good politician, wouldn't I? Because I think you start off this segment asking that question, and in return, I talked around it and never answered. So here we go.
Okay.
The bottom line is if you are 50 or older, if you are a member of the income generation, instead of crossing your fingers and toes, you should invest for income. Why? Because income, i.e. interest and dividends, is like a bird in the hand. And at the end of the day, you can't spend growth or capital appreciation. You can cross your fingers and toes hoping to get it, but growth turns into shrinkage sometimes when the markets drop. So we're focusing on things like bonds and bond-like instruments.
Okay.
And there's 7 or 8 things, the things we talk about in the show all the time. Because if you understand the deflation argument, then you should have no concerns at all about buying those types of things right now. And at the end of the day, if you can't live off 1% in the bank, and most of our viewers can't, right?
No.
Then you've got to get a higher income rate than that.
Okay. Well, that was a much better answer than stuff everything in a mattress and hide under the bed. So I appreciate that. And I know you have some final thoughts, so I look forward to hearing those.
In sports, you certainly can argue that cheerleaders make sense and serve a purpose. Let's face it, they help fuel positive emotions for both players and fans, and that can impact their performance in a very positive way. It can also impact your enjoyment of the game. Their cheering, even in the face of loss, helps you keep things in perspective. It helps you remember that, hey, it's only a game. But when it comes to your life savings and investing for retirement, there's a lot more there than just a game. And cheerleaders should not be involved in it in any way, shape, or form. Different Wall Street cheerleaders may have different reasons for constantly cheering and steering you toward the stock market. But what they most probably have in common is that they neglect the inside game. They ignore important details and all the other core values that are so important in helping you protect your money in good times and in bad. And after looking at some of those details on today's show, I hope it's just a little bit clearer why I believe Wall Street cheerleaders are not only inadequate for the income generation, they can be outright dangerous. At the end of the day, with so much uncertainty and artificiality fueling today's markets, I believe the inside game and possessing those core values have never been more important, starting with the first value, overprotection. And that's simply not something you're likely to hear or get from a Wall Street cheerleader. Now, before we go, I want to just thank all of our regular and new viewers also, as well as my guests today. I also want to encourage you to learn more about today's topic and about how you can get your own copy of Return on Principle, 7 core values to help protect your money in good times, in bad. How? Simple, by visiting the website on your screen, returnonprinciple.com. And for other free materials and more information on the show, as always, you can visit theincomegeneration.com. I'm David Scranton, and thank you for watching.